Welcome everyone, and thanks for attending our webinar today. Also welcome to my colleague Sandile Malinga for attending the webinar with me and hosting it with me. As you might know, Sandile is a portfolio manager in our multi-asset team here at M&G Investments. You're all aware of the recent changes to Regulation 28 that governs the investment limits within retirement funds, and the significant increase in maximum offshore allocations within those portfolios from 30% to 45%, ignoring the Africa limit. That's quite a significant increase in our view, and if I listen to most market commentators outside, it seems like most allocators' gut feel is that they should make use of this additional flexibility and significantly increase their offshore allocations. In our view, this is a significant investment decision to make and something that one should spend an enormous amount of time on to ensure you get this right. But not only that, we also think this is potentially a change that can impact business models within the asset management and multi-management industry. So let's jump straight into the discussion without further ado. What I must just say is today we'll focus on what is the offshore asset allocation for a multi-asset portfolio, specifically within Regulation 28, and then particularly we'll focus on what is the offshore asset allocation towards offshore asset allocation, as I mentioned. What we're not focusing on is what is the ideal offshore asset allocation for a person. Each one's own circumstances are very different, and that is something that we would suggest you speak to your financial advisor about and come up with the right answer for you as an individual. So we'll focus on the multi-asset portfolios that we manage. So Sandile, the determination of an appropriate strategic asset allocation is quite an important part, specifically at M&G Investments, and we see it as an important part in our investment process. Can you just start off by explaining how we view that process?
Sure. Thank you. Thank you very much. And once again, welcome to everyone, and thanks for joining us on this webinar. We're very excited to share some of our results with you, and hopefully they help in your determining what is appropriate for your own particular investment problem. So as Pieter has set out, we think about the investment problem, and particularly the multi-asset investment problem, in three interrelated but quite distinct buckets. The first is if someone came to us with a blank sheet of paper and said, I want you to manage my portfolio, I want you to manage my capital, and I would like you to generate a particular outcome for me. The first thing we would do is blank sheet of paper. We would then sit down and think about what are the client's objectives. Okay, what are they trying to achieve? And even more importantly, what is their risk appetite? Now, risk appetite is a very hard thing to define, and there's reams and reams of theoretical and academic research around determining the risk appetite of investors. Our problem is slightly different in that we have a whole bunch of investors in the portfolios, and because we have a whole bunch of investors in the portfolios, we can actually determine at quite a broad a level what is the risk parameters that we want to take in the portfolios. Now, the other challenge is obviously no one can tell the future. So given that we acknowledge we can't tell the future, and given that we acknowledge we don't know anything about what's going to happen in financial markets in the next minute, and even less in the next 10 years, how do we actually build portfolios? So we make use of, yes, some academic and quantitative and qualitative tools, and we use those to determine what we would call the strategic asset allocation. And in very simple terms, a strategic asset allocation is what mix of portfolios do you want to hold in order to achieve a certain investment outcome over a sufficiently long enough period. And it's not a buy and hold strategy. So if you go into Google and Google strategic asset allocation, one of the first things that come up is it's a buy and hold strategy. That's not quite correct.
Not in our view.
Not in our view. So what is a strategic asset allocation? Well, like any investment strategy, it has its pros and cons. So through this particular webinar, we'll discuss both the pros and the cons, and why we think applying our own judgment and sensibility checks, why we think this approach is the best way to manage multi-asset portfolios. But in a nutshell, the strategic asset allocation is almost like your GPS coordinates. They tell you where you should be going in order to achieve your investment outcome.
So, in fact, while right at the start, you start with a blank sheet of paper, you create that GPS coordinates for a specific portfolio or a specific client, and then you use that as your starting point every day and see where do we go to from here.
Correct.
That you don't start every day with a blank sheet of paper.
No, I mean, that's impractical. And also, that's no way to manage other people's money. It's not responsible. So one of the things, in particular philosophically, for us, strategic asset allocation is quite important in that it helps to keep us honest. And any deviations from that strategic asset allocation have to be well thought through. So it's almost as if every single day we have to justify why we have to deviate from strategic asset allocation.
Absolutely. As you get bombarded with new news every day, a lot of news flow.
Noise,
and
changing economic and fundamental circumstances as well.
The world changes.
Yeah.
So obviously the strategic asset allocation is an important start to our process. From there, on an ongoing basis, you would deviate, as you say, depending on the circumstances, and we call that as the tactical asset allocation part.
Yeah.
And from there, we allocate to certain asset classes where our teams look inside that to see if they can add stock selection alpha.
Correct. But I mean, before we get ahead of ourselves, we should probably discuss what goes into a strategic asset allocation. Yeah.
And today, I mean, the purpose of this webinar is we're going to mostly focus only on the strategic asset allocation part. So how do we start with that process? How do you start from your blank sheet of paper and get to an appropriate strategic asset allocation for a particular portfolio?
So, as the graphic we've put up suggests, there are key inputs into determining a strategic asset allocation. And, one of the key inputs is to find out where the client's trying to go. Okay, and that is expressed in fairly simple terms for us anyway. Where the client will tell us, these are my return objectives. So one set of clients might say, I want you to beat inflation by 5 percentage points over a sufficiently long enough horizon. Another set of clients might say, we want you to beat the average balanced fund, for example. And having spoken to us many years, it's a difficult thing to do. So you don't know, one of the problems with both of those as objectives is that there isn't a particular asset you can buy that explicitly gives you, I'm going to beat the average balanced fund manager. If there is, it comes with a whole bunch of other unintended risks. So our objective is to take that objective, so take the GPS coordinates, and then frame that in a way that we can use different combinations of assets, both local or domestic and foreign or offshore, and we expect over the long run that combination of assets to get you to very close to that destination.
Absolutely. So let's start with the client's objectives or the fund's objectives and dive a bit into that detail and give us some examples of what that might look like and how that starts to influence your process.
Sure. So, one of the key things is to set out what the client expects. And in that, we then will overlay, do we think these expectations are reasonable? So, we would never be comfortable accepting an objective that we know we can't achieve because, fundamentally, the returns we're able to generate come from the assets that we are investing in. So if a client then says, I would like you to earn or to generate CPI plus 10, we will find that very hard to do given the opportunity set. We invest in listed liquid markets. We don't take leverage in the portfolios, and we basically use the tools and the ingredients that we have to come up with return expectations. But that's one half of the story. The other half of the story is obviously what are the constraints or where can you go, right? So if for example you're booking a plane ticket, you can go directly there. Or you can take some detours, or you can take some layovers, and those are the parameters or the constraints, the rules around which you can operate. And examples of those rules are obviously tying it back to the recent increase in our offshore allowance. You can now invest 45% of the portfolio in foreign assets or offshore assets. And that is a very important strategic decision, because as we've said, from the word go, when we start thinking about the problem, we set our strategic asset allocation. And the output of that is going to tell us, in a reasonable way, where assets are fairly valued, this is where you must invest a portion of your portfolio in South African equities, global bonds, and South African bonds.
Absolutely, and even Reg 28 allows us to go up to 75%
of equities,
SA equities, or 100% in SA bonds, and we don't always go there. It starts with what the client wants, so I guess that discussion with the client of what are their investment objectives is absolutely important part of the process. And then I guess the risk part and the rules are also quite important.
Absolutely.
Talk to us. So how do you start with the process further once you've got clarified what the investment objectives is?
Sure. So then, we would then talk about once we have the target, once we know the rules that we need to operate in, we then look around and we have a number of ways to tackle the problem. The way we've chosen to tackle the problem is in a fairly rigorous and systematic way. We think about what the returns that we can generate from particular assets. We think about whether we can add value on top of those returns. We think about whether the approach that we're taking is the right approach. There is no single answer to a particular investment problem. And really, we then use those, sensibilities and thinking about the constraints, thinking about what is possible in investment markets. We then use those to come up with a set of candidate options.
Potential asset classes.
Potential mixes of portfolios. And really, this is where, things get quite interesting in that now you're operating in a world away from where I'm very comfortable with numbers. Now we have to apply our judgment to say, okay, now that we have these portfolios, how do we pick which is the best one to pick?
And which is the best combination?
Which is the best combination of assets? And as the graphic sets out, this is the realm of stress testing and ensuring that whichever solution you come up with is robust. You're not just building a portfolio for one particular event. You're not just building a portfolio based on one history, for example. We do a lot of work to almost panel beat the portfolio to make sure it's fit for purpose and can handle unforeseen shocks, because every day is an unforeseen shock.
And I guess that's where you get into the various risk parameters.
Absolutely.
Because it speaks to the journey that gets you to the end. And as we've seen in investment markets, it's not just the outcome that is extremely important, but also the journey that the client takes, and if they can handle that type of journey. So that's where you jump into the risk parameters or the risk metrics of these asset classes.
Yeah, and really the outcome that you want at the end of a 10-year period, for example, is for your client to say, okay, I'm happy with the returns that you've generated, like you've said. I'm comfortable with how we have gotten here. Okay, one of the things we try not to do in investments is to take unrewarded risk. And this particular liberalization of our foreign allowance opens us up to massive amounts of unrewarded risk. And we'll get into the details a bit later on, but this is where it has to be a strategic decision, and you have to think about it quite carefully, because if you're taking unrewarded risk, it has the potential to actually deviate, and you might not actually even get to your objectives.
Absolutely. Yeah, and I guess the most important thing is, in general, we prefer a wider tool set to play with. More flexibility is better. It gives us more options to deal with many more circumstances that the world throws at us, and certainly there hasn't been a shortage of those.
Yeah.
So in theory, definitely wider offshore flexibility is a good thing.
Yes and no. Once again, to use a tired cliche, with great power comes great responsibility.
Absolutely.
So, we're very excited about the prospect of being able to generate significant amounts of value for our clients by investing in more of our portfolio in foreign assets. However, it has to be done in a way that it makes sense. We don't want to be, for the sake of it. Yes, we have 45%, but is that the optimal amount to have? And what are you giving up? Because it's always a trade-off.
Yeah, and I think the important thing for the audience to note as well is the portfolios we run in rands. So what the client sees is the rand return and the rand risk. So even if you have foreign assets in the portfolio, it gets translated into rands, and they see that volatility. So obviously the impact of exchange rate is a big part of the equation to consider.
Yeah, I mean, when you think about it, when you take global assets and you express them in rands, something like a global bond, for example, like a US Treasury, in dollars, it's a fairly safe asset. Well, if you don't talk about the last 6 months. But in general, it's a fairly safe asset in dollars. But when you convert it into rands, that rand conversion or the rand translation comes with a lot of extra, what we would say, unrewarded risk.
Okay. So let's go forward. What is the next step in the process for you?
So and this is, I think, where there's a lot of opportunity to get things wrong, and this is where, with any model, right, and really our strategic asset allocations are models that we build as an approximation for the best, what we would say, the optimal way of achieving those objectives. And with any model, you need good inputs.
Absolutely.
And one of the key inputs that goes into our SAAs are equilibrium return assumptions. So these are very important because at base level, they set out what is achievable. So we look at cash, for example, South African cash. What is the reasonable long-term return expectation? There's various ways of estimating that. And thankfully, we've got a fairly long history that we can rely on to try and frame our thinking about what we think the future returns are going to look like. So once we've set those return expectations, we then have a guide on what we think we can put together to achieve the objective. So, for example, like I mentioned earlier, the example of a plus 10 objective, if we, for example, if the highest earning or return available to us is 7%, we can't make that 10%.
Absolutely.
So this is where, at the start, it's very important for us to sit down with the client and say, okay, this is how we think about it. And this is what we think is the best potential asset combination. And we think this is what you will get with some level of uncertainty, obviously, but it should give you a reasonable estimate.
So you start building what your expected returns are from cash, and how do you take it from there all the way to equities?
Sure, and I've admittedly received a lot of questions around this particular part of the process, and it's always good to reiterate that these are assumptions. They're not forecasts.
They're not cast in stone.
They're not cast in stone.
We can change our mind.
We can change our minds.
Change.
Exactly. So how do we think about equilibrium returns? The first is to take a step back and really ask ourselves, what is it that you're being paid when you buy an asset? And we like to think about these in risk premium space. So we set out with the notion that when you take higher risk, you should expect and demand of an asset higher returns. So let's take cash, for example. Cash is a low volatility asset. You don't invest in cash if you want to earn high returns because it doesn't come with a lot of risk. If we go to the other side of the spectrum, property and equity, listed property and equity securities, for example, come with a lot of risks. So the risks for an equity is obviously you sit at the bottom of a capital structure. So when a company makes money, you are the last person to be paid as a shareholder. And all of those other people on top of you have right of access to whatever the profits the company is generating before the company can pay to you. Okay, so that in itself is inherently a risky activity, which is why shareholders tend to demand the highest return from buying companies. And we then, so we build it from, let's start with cash. We then go on to the next riskiest asset, which is inflation-linked bonds. They're not risky in a real return sense, but they're risky in that you've tied up your money for a significant amount of time. Nominal bonds, for example, are riskier than inflation-linked bonds because the cash flows that you're receiving are nominal, and there's some uncertainty about what the real value of those cash flows is going to be through time. So this extra risk, we would call it an inflation risk premium, is simply the uncertainty about what your realized real returns going to be.
So as investors can see on the slides, it's obviously as we build it up from cash, you add the inflation risk premium on top, and so you go up from the cash return.
So higher risk, higher return.
Absolutely.
But the subtlety then comes in when we compare local assets to offshore assets. There's no doubt about it. South Africa is a small, open economy. It's an emerging market. And unfortunately, over the last decade, has been a market characterized by low growth. So inherently, the cash flows that the assets we invest in South Africa are riskier than cash flows we can invest in a well-diversified global asset base. And I said earlier, higher risk, we demand higher return. So the question for me, I'm fairly comfortable buying a Brazilian bond, for example, if it offers me a better return than what I can buy locally with commensurate risk.
Yeah.
So put another way, we are fairly agnostic about which assets we buy. Obviously, we operate within constraints, but we are seeking to generate the highest return for a given level of risk. And given that global assets, a well-diversified global equity portfolio, is a better and less riskier alternative to South African equity portfolio, that asset, by definition, should generate lower returns.
Higher return. So then it's obviously, as you can see on the screen and on the slides, your global cash, we think, because it's a much more stable than South African cash, it would offer you a lower rate of return.
Absolutely.
And then you build up from there towards your equities on both sides of the picture.
Absolutely.
Okay, Sandile, and then you get to the crux of it, what our equilibrium real return assumptions are that we put in the process, and I guess that's the major input into the entire process.
Absolutely. So as you can see, all of the South African assets are offering us higher returns, higher real returns, because they are higher risk. Yeah. And I think that is the fundamental difference in how we approach it. We want to buy assets that are paying us returns, but those returns have to be compensation for the risks. And when you start going to areas where you're reaching for returns, your portfolio will necessarily be a portfolio that is comprised of the majority of your assets will be in South Africa, because those are the returns, the highest returns that you can find. So the question around, should you be taking 45% offshore, you can see that actually the question is how much to have offshore, not necessarily should you be at the maximum, because the trade-off is you're giving up a lot of returns for going offshore.
And if you go to offshore and you go to first world markets, you are inherently mostly going to safer markets potentially than South Africa, which is therefore offering you a potential lower rate of return.
I wouldn't say all of them are safer.
Especially not Ukraine and Russia and Turkey and the like.
Exactly. But you are, in a broad market sense, you're picking up, when you buy a global equity portfolio, you're picking up a well-diversified set of countries. You're less exposed to SA-specific risks. So yes.
Absolutely. And Sandile, the other thing on this slide is the market beta that is provided, that's obviously what we discussed mostly. Do you want to just touch on the alpha generation ability or of these various classes?
Sure. So this is where I'm going to embarrass my colleagues a bit by talking unabashedly about their ability to generate good outcomes for our clients. You can see, on top of the SA equity beta, so the market return, we have an expectation of earning an extra 200 basis points. And that has been our experience of running SA equities for the last 2 decades. So we think that process of generating 200 basis points is fairly well embedded, that you can rely on it going forward. Similarly, for South African bonds, for example, 100 basis points on top of, or 50 basis points on top of 3% is not a bad outcome. So we are relying both on our ability to put the portfolios together in a meaningful and sensible way, but also in the underlying asset classes where my colleagues spend a lot of their time picking stocks and buying and selling bonds to generate the extra returns. If you're listening carefully, what I'm trying to say is we have an edge in South Africa.
Absolutely.
Do we have an edge in global markets? Yes. I mean, we have a fairly well-resourced team of investment professionals sitting in London, sitting in Chicago, some sitting in Singapore and Hong Kong. And they are themselves also able to generate alpha from picking stocks and buying bonds in the various markets that they operate in.
Absolutely. Sandile, and I think the big challenge that most people looking at this slide will pick up is to say, is this correct that South African equities offer you so much more than global equities? That certainly hasn't been the case in the last couple of years. Is this time going to be different? How do you guys think about this?
Look, I mean, South Africa should pay you more because it's a riskier market. I'm starting to sound like a broken record, but that point is so fundamental and it's critical in thinking about which assets you want to add. What you've just highlighted is what people who operate in financial markets and look at something called behavioral finance would call recency bias.
Absolutely.
Our expectations are, as humans, we are hardwired to think about the most recent events and put an undue weight, if you will, of experience on those. And there's no doubt the last 10 years have been an absolute shocker for South African equities. You can see we've underperformed global equities. We've barely generated 5% per annum, whereas global equities have generated 12% per annum. And these are real returns. So we've adjusted for South African inflation. So these are phenomenal returns, right? But our experience is that, events like the last 10 years or regimes like the last 10 years are atypical. So if we look at the previous 10 years, for example, South African equities absolutely dominated global equities. And that, we would say, is the right way that the markets should behave. There's obviously a whole bunch of reasons why we underperformed in the last 10 years, but over the previous 10 years, the equity returns were gangbusters. Global equities actually delivered negative real returns for 10 years.
Yeah, and many people forgot that during the 2000s that US equities effectively did nothing for 10 years. And over the last 10 years, most South Africans has taken as much money as they could offshore and into global equities.
And have enjoyed it.
And have done very well from that.
I mean, I don't remember the previous 10 years because I wasn't around. But if we focus on the longer term, the absolute long term, which is where the strategic asset allocations tend to come into their own, the relationship between South African equities and global equities is such that South African equities, being riskier assets, have given you and generated higher returns. And we can see the numbers for ourselves. So when we set our forward-looking expectations, we do a lot of work to understand what is the driver of these cash flows for these assets, what is the risk that the cash flows are presenting, and do we think our estimates more well compensate you for the risks that we can in any way reasonably get our heads around.
So let's dive a bit into that, because on the one hand, clients might say, since 1900, that's 120 years, that's a very long
I definitely
time.
wasn't around then.
The most recent 10 years is more important. How did it look in the decades prior to this? Maybe we can
Sure.
have a better look at the longer term picture.
Well, before we get there, I think it's very important to appreciate the power of compounding. So, annualized since 1900, South African equities have generated almost 7% real returns. Global equities 4.1. That 300
significant
base
difference.
is a significant difference. Compounded over 100 years, I can't even do the numbers myself, but it's a very big number. If you look at on average, so the mean of decades, similar picture. You have had a little bit more variability for global equity returns, but they're still lower than South African returns. If you look at 50% of the time, or you know, how have SA equities done, they have once again outperformed global equity. So we're not cherry picking specific periods here. We're looking at the longest history that we have, and we can compare. But looking at the decades, for example, you know, our observation is that in most periods, South African equities tend to outperform global equities. So to expect the last 10 years to persist forever is a pretty big call. And you know, bringing financial theory to bear onto the problem suggests to us that what's happened over the last 10 years is probably anomalous. It could carry on, but it would be anomalous.
Less likely.
Less likely.
Like we've got a little taste of in the last couple of months already.
Sure. I mean, look at what happened in 2021. Even in the event where markets were selling off, South African equities actually outperformed almost all other global equities.
Fairly well. Yeah. And I guess clients looking at this will say, okay, so that is the history. Are we not too backward looking? Should we not be forward looking in terms of these returns and the assumptions we make between these asset classes?
Sure. Look, I mean, our real return expectations are forward looking in nature. So here we're comparing global equities and South African equities. And we've put the bond yield, which is the starting point in understanding and generating that long-term real return expectation. And we've also put the equity risk premium. So 2 points to make on this particular slide. The global bond yield is significantly lower than South Africa's bond yield. So, you know, a client asked me the other day, you know, do I not think that the equity risk premium for South African equities should be higher than global equities? That's a reasonable question to ask. We have, I mean, I have been a broken record saying it's a riskier market, but we've captured that in a higher bond yield. So the higher bond yield effectively means that the sovereign risk of South Africa is higher. So all assets that are derived from that sovereign risk are then also higher. Specifically when it comes to the equity risk premium, I think one of the things we forget is the fact that a large portion of revenues generated by South African companies actually come from offshore. So when you're buying a South African basket, a basket of South African stocks, you're actually buying a fairly well-diversified basket of stocks by revenue and geography. And we've compared it to the US, for example, S&P 500, the proportion of revenues that come from offshore is around 30%. So our equities actually generate more from the investments that they've made offshore. Which,
and not all in first world markets.
Not all in first world markets, and it mitigates somewhat how high that risk premium should be.
Okay. And the various constraints we put on, so if you use this and you start putting it into your process, where does that lead you?
So we've spent a lot of time talking about the return side of things. Yes, very important. Yeah. But the risk side is equally important.
Absolutely.
So, you know, if we look at, this is a correlation matrix, and it just looks at the correlation of returns between South African assets, between themselves and global assets. And the key thing here is the function that global assets, and this is where global assets actually come in to their own. The function that they serve in our portfolios is to help mitigate somewhat the South Africanness of our portfolios. So in statistical terms, we are picking up assets that are likely to go up when our assets are going down, which is a very useful thing to have. Obviously,
Like a shock absorber.
it's a shock absorber. Obviously, you're giving up a lot of return. We are happy with that because we think over time, giving up those returns actually makes the end outcome of our portfolios significantly better. The other quite interesting thing here is to note that, you know, almost all South African assets have a negative correlation with global assets. SA equities, negative correlation with global cash and bonds. So those assets do quite a neat job in shock absorbing some of the risks that come with South African equities. But global equities and SA equities have a fairly high positive correlation, which, you know, once again speaks to a lot of the drivers of our equity market are actually global in nature. So when you go offshore and you're buying global equities, you're giving up the edge that you have being a South African investor in South African equities, but also you are you're doubling up almost on the foreign or offshore element of your equities by buying direct foreign equities. And you know, what you buy is very important. You have to know what you're doing. For example, you know, picking stocks in an all-country world index, you're looking at around 8,000 different stocks. It's a very hard problem. We struggle to manage and to cover, you know, 100 stocks in South Africa.
So if you don't have capability in all those various markets, this is not an easy game to play.
It's not an easy game to play. You have to have an army of analysts to give it a proper go.
Sandile, I think the important thing from this slide is, and I've seen it in the media where people will look at it and say global bonds is a risky asset in terms of volatility in rand terms.
Yeah.
But it's not just about that, but it certainly seems like if you load your portfolio with SA equities, global bonds seem to be a very good shock absorber for that.
Well,
in terms of a slightly negative correlation.
I mean, the numbers are there. So, you know, global bonds play a better role in hedging South African nominal bonds and South African inflation-linked bonds more than they do equities, for example. And that's exactly what we want. You know, global bonds act as a shock absorber, and we're very happy to give up some of the returns because, you know, in stressed environments, those assets go up when our assets are going down. And as we saw in March of 2020, that's a very useful thing to have. And you certainly, it's almost an insurance premium. You're lucky if you can get that insurance premium with a positive real return. Sometimes it's not possible. But, you know, when it pays for itself, it more than makes up for it.
Absolutely. It's like buying insurance, but you don't pay a premium. If you can get a premium back, it's very useful.
Exactly.
So if you put the risk and return characteristics together, you now put it into your modeling machine, not really machine, but in the team, and you start thinking about it. How do you take this process forward?
So once we have our inputs, once we have the risks, once we do a lot of analysis and work to make sure that those estimates are robust, the risk estimates themselves robust and are fit for purpose for the regime we think we're in, then we put together the portfolios. But we don't spit out one portfolio. We literally have thousands of portfolios to choose from. And that's where we apply the human overlay, the stress testing, and other quantitative tools to help us narrow down the range of options. And the final portfolio, which would be the strategic asset allocation, is the outcome of all of those inputs.
That portfolio. So effectively, I mean, looking at the next slide, you're trying to put together a bunch of all these various asset classes that provide a risk and a return. And the combination should give you something that is much higher return at less risk. I guess that's utopia you're searching for.
Yes, and we're lucky to be able to find it sometimes. So, you know, if you look at some of the building block assets that we use, South African equities, global equity, global bonds, and South African bonds, and you put them on a risk and return spectrum, you can see the real returns that they generate on the vertical axis, and you can see the risk. And in this instance, we've just used standard deviation as a shorthand for risk. You know, the further you move to the right, the higher risk the asset, and you hope you're actually generating a higher return as well. Combining these assets allows us to, like you said, find utopia in a way, find portfolios that are generating high returns at a reduced risk to any one of those assets. And that is what we're doing. We're combining all these assets to lower the risk and to increase the return.
So effectively, you want to move towards that efficient frontier.
So that efficient frontier, I mean, it's quite a technical term, but all that line tells you is that that is the maximum, that is the most efficient portfolio you can build, given the combination of these assets. So if you lie on that line, you're doing a great job.
In terms of risk and return, risk in terms of standard deviation.
Absolutely.
Yeah.
And you know, one of the things we do is to say, how do we know what we are doing is correct? Because, you know, we don't know the future, our estimates might be wrong. And like I said, we cycle through a lot of portfolios. You know, on the next graphic, we've got a result of this process where we've looked at thousands and thousands of portfolios, differing combinations of all of those assets together.
Possible
all of the
portfolios
possible
given
portfolios,
those asset classes.
given the asset classes, given the constraints, and this is what it looks like. So one of the things that the increased foreign allowance has done is to introduce a higher limit on what you can buy offshore, and that changes somewhat the possible portfolios that you can generate. So when we looked at a whole range of possible portfolios and we went close to that 45% limit, what we found was quite interesting. The higher your foreign component in the portfolio, the further right your portfolio was. And if you remember...
In other words, you're starting to move away from this utopia efficient frontier.
Not necessarily. So always, you know, if you're moving right, you want to be getting a higher return. But what we found was that's not possible because, as a start, we've got lower return expectations for global assets. So we're moving further right, and we struggle to move up to generate higher returns, which suggests to us that 45% is probably not optimal if you want to be maximizing the returns on your portfolios. Even after looking at all of these options, we simply couldn't find a 45% portfolio that would give us sufficiently high returns to justify holding those assets in that proportion in a strategic sense.
And I mean, I think you've got a picture here on how our portfolios will look like in this,
sure, I can share that
in this sense. So effectively, we're trying to get there. In examples of our M&G balance and inflation plus portfolios here, I guess the first question is, why aren't they on the efficient frontier? And I guess the discussion is there, we're looking only at risk in terms of standard deviation here. What we're not going to go into today, we look actually at a whole host of other risk metrics like maximum drawdown or peak to trough drawdowns. We won't have the time to go into them today, but you optimize the portfolios for those risks as well.
Yeah. So we don't just look at volatility. We, as you've mentioned, have a battery of risk measures that we look at, and we build the portfolios to minimize those risks across all of those, not just best combination. Yeah. And when you compare it to just a standard deviation type analysis, it might not be the most efficient. But you know what? We're quite happy with this because we know that on other risk measures and other risk events that are not captured by this statistical measure, the portfolios do well.
Yeah. So you get different portfolios that some others might focus more on drawdowns, and you'll obviously look at optimizing for that.
Yeah.
And how do you know this is the most efficient outcome?
So let's take our balance fund, for example. Our current strategic asset allocation weight in offshore assets is 28%. It's fairly efficient. It's quite close to that line, and it gives you a sufficiently high enough return. We then said, let's optimize for higher weights and see what that looks like. So we took our balanced fund constraints and we said, we want you to give me a portfolio that has a 40% weight, and we looked at
40% offshore.
40% offshore, and we made sure that we're comparing like for like in terms of risk. So all of the portfolios, so the 40% that we picked and the 45% portfolio that we picked had the same level of risk as our own portfolio. The thing we found was that, like the graph suggests and like the cloud of dots suggest, the higher your foreign weight, the less efficient your portfolio. And you can see the bar chart on the right-hand side. We are generating a fairly efficient portfolio. Here, efficiency is simply defined as the level of return per unit of standard deviation.
Absolutely.
And you can see the higher your foreign weight, the lower your unit of return per unit of standard deviation or risk.
So some clients might want to have more offshore, but they need to understand at what price does that come.
The trade-off that
for various other reasons.
Absolutely.
So how would you, if you had to look at a range of portfolios, because the other thing I think I often read, I see people don't pick up on it, is portfolios who need to deliver different levels of return. Presumably, they don't have the same answer in terms of what is the most
absolutely.
optimal
I mean,
allocation.
there isn't a single answer for a balanced portfolio, so you have to apply a judgment. And there isn't a single answer for a wide spectrum of portfolios. So here we've got portfolios from a +3 all the way up to +7. Those are real return targets. We've got some similar constraints on these, such that these portfolios are Reg 28. And the proportion of foreign or offshore assets in the portfolios really tops out at around 25%. We obviously have a slightly higher weight in the Global Balance Fund, but it's to take into account those other risks that we're talking about. So 25% seems to be the optimal weight.
Sort of the ideal.
The ideal weight
total.
in total, right? Because you're not just looking at how much in global equities can I buy. You're looking at what your global total portfolio is doing to your portfolio and what you can actually generate in terms of returns. The other interesting thing is, the further you move to the right, obviously your global equity weight goes up. I mean, when we look at domestic-only portfolios, the portfolios that give you the highest returns are those that have the highest equity weights.
Absolutely.
And the same is the case in global assets. Now, the trick is obviously, it was fine to not have to think about this in sort of fundamental terms when the weight of your portfolio was small. The weight of foreign in your portfolio was small. But now that you're looking at 45% you can potentially allocate, the mix of these assets is now suddenly very important. What you're actually buying is suddenly more important, and the relative proportions and what that does to your total portfolio risk.
Yeah, because when I look at most South African multi-asset portfolios prior to this, up to the 30% maximum, if I go and look at what is inside that 30%, it's mostly equities, even for lower risk portfolios. And I guess many of them maybe can run South African equities from South Africa, or global equities from South Africa. But I mean, global bonds is a very different ballgame.
It's a bit more specialized. And it makes total sense, if you have a high returning portfolio, why you would concentrate your efforts on global equities. But like you say, in the sort of lower end of the return spectrum, it's very important to have a really proper process to think about and pick global bonds. Why? Because those lower returning portfolios tend to be those with a higher SA nominal bond weight. And as we saw, the best asset class to hold if you want to hedge your SA South African risk, your shock absorber, are those global bonds.
Absolutely. And Sandile, again, this is obviously the optimal starting point for us. You guys have no issues to tactically allocate over and above that depending on valuations in the market.
No. So at the start we said we are restricting our conversation to the strategic side of things. So have we achieved what we set out to do? We know our portfolios reach those return targets over the medium to long term. We know that the portfolios are the most efficient, so you will struggle to find portfolios at the same level of risk, giving you better returns. And we know that we purposely built them explicitly using the risk constraints that we're given, such that there are no surprises at the end.
Absolutely.
So those, the blank sheet of paper,
boxes
are ticked, it's now a roadmap. But assets are never priced at fair. And the most exciting part about this particular development, in that we can now allocate a higher proportion of the portfolios to offshore assets, is that now we can actually, in the same way that we use the expertise that we use internally with our colleagues in South Africa to pick stocks and buy bonds, now we can actually say we can do that on a global level, and that's quite exciting. And because we are able to generate extra returns by using the expertise at our disposal, that should be a better outcome for clients over time.
Absolutely, and I guess that's where we can lean on our colleagues globally across the world, sitting all working for M&G Investments. I think the slide on the screen is a picture of the investment offices in our company, and I guess you can see they're situated in all the main capital markets in the world, the assets that you would like to see in your portfolio, the US, UK, Europe, the East. So you have constant conversations with these colleagues when you talk about the tactical asset allocations, i.e. how to deviate from the starting roadmap given where the world is today.
Yeah, and more often than not, what we hold in the portfolio will be different to the strategic asset allocation, because the return opportunities are different, or the risks are different. And now we can pick up the phone and call up our colleague in Chicago and ask him what he thinks about US high yield, for example. I'm not an expert on that, but I have a colleague who's an expert on that, and who can help us address that question.
Absolutely, and that's constant conversations on an ongoing basis, and the portfolios get tweaked around that. And it certainly seems like there's significant scale and capabilities in those markets that we can lean on.
I mean, this, the higher offshore weight it should be something that we are clamoring to do. I can go to London, and I can go sit in Singapore if I want to, and run the money from there. But that's not, the optimal thing to do for our clients. What we want to do now is to be a lot more tactical in allocating between different assets across the globe.
Yeah, and it's certainly the question I'm getting from many clients is, you guys have got the scale and capability offshore. Should you not be shouting, take 45% offshore? But I think you've answered it very well.
We have to do what's right for our clients.
That's exactly what we're trying to do. What is the most optimal portfolio? Yeah. So Sandile, in conclusion, I think you've given us very, very useful insights. So thank for that.
It's a pleasure.
Some departing thoughts on how we should think about this problem and take this forward.
So the three things I have learned through this process, the optimal weight, you have 45%, but that is not the optimal weight. So allocating up to 45% has to be well justified, and you have to be buying assets that are significantly better than what we can find in South Africa. 25 to 30% is around the optimal weight. It could be slightly less than that in the case of our balance fund, because we're balancing other objectives. But we think, you won't go wrong if that is your strategic optimal weight. But now we can do other things that we couldn't do before. So we can now allocate even more offshore. So if we think foreign assets or offshore assets are significantly cheap, we can go up to, 40% if we want to, because we have the regulatory space to do that. The second thing is, higher offshore assets is not necessarily the best investment answer for your portfolio. So, what we are trying to do is answer investment questions, and what we're trying to do is help our clients with the investment outcomes. And to our minds, 45% is not the optimal weight. And finally, I think, in the fact that now we have a bigger portion of our portfolios that we can manage offshore means that the capability of the manager that you pick to go offshore with is very important. And we are certainly availing ourselves even more of the expertise that we can access in the various offices to help us, achieve the best investment outcomes for our clients.
Yeah, thanks, Sandile. And absolutely right. It's not just how much you take offshore. What do you do with that offshore, and who's the partners you pick to help you with that? So thanks so much for the very interesting insights. I think we've picked up quite a number of questions in the chat, which from our audience, and I think we should turn to that and try and answer a couple of those. I'm sure
I'll do my best.
There are many.
Let's go.
Thank you everyone for listening and certainly sending through a number of questions which I've got on the screen in front of me, and my colleagues also gave me some on paper here. Sandile, I think the theme that comes through a lot is about SA equity returns and slow growth in South Africa that we've now been experiencing for a while. Can you help us how you stitch those two together? Is there a correlation, or is that not something useful to look at?
No, look, ultimately, there's definitely a link between economic growth and the opportunities available for companies to generate earnings, grow those earnings. But the link between, top line GDP growth, for example, and revenues for SA companies is tenuous. And part of that is explained by the fact that, by some estimates, up to 70% of revenue from, JSE listed companies actually comes from offshore. So, it's less about what is South Africa doing, but what are the markets in which these companies are operating doing, and how are they offering them opportunities to actually grow earnings. So, it's as always, it's a complicated question. And the answers are quite nuanced. But even if you just, do a simple regression, it's a very tenuous link.
Yeah, and you and your team has obviously done this analysis not only on South Africa, but on
across the board. Yeah. So if you look at a cross section of countries, economic growth as measured by GDP is a poor predictor of future equity returns.
Absolutely. Got a question here from Ibrahim Ibisomi at African Reinsurance Corporation that deals...
That's a tough one.
Yeah, it effectively deals with what precautions need to be built into offshore investing to address the limited knowledge of local managers of foreign markets and lack of control over the foreign investment instruments that get selected. And maybe I'll couple that with another question along the same line is, should you outsource the foreign piece of your portfolio to foreign expert investors, or is there benefit in having a single manager being able to look at your total portfolio?
Yeah, look, true to form, Ibrahim's question was quite hard. Thanks for that. But okay, so to take a little bit of a step back, the model that we apply has evolved over some time, and part of the evolution was an acknowledgement that us picking specialist managers in global, in US equities, for example, was suboptimal. Part of the problem is, like Ibrahim has identified, you basically giving the money to the manager, you leave them alone and they do their job. But also, if you're operating in a constrained environment and you're quite close to your regulatory limits, if your global manager wants to be overweight equities, it forces you then to have to react. So, the tail's almost wagging the dog.
You need to counter on
correct. And that's suboptimal. And now we're sort of veering into territory where we're punting our own books. But an integrated approach is probably the best way to go, because you control all of the inputs. You're able to make a holistic call on the portfolio. You're able to balance the risks between different asset classes at one level. And I think we are certainly well placed to do that, given as we've shared, there's a whole host of teams all over the world who invest in their own markets and in global markets that we have access to, and we can partner with and work together in achieving some of our investment objectives. So not once again talking our book being a globally integrated asset manager, but you will struggle to be able to credibly say you can pick US equities sitting in Cape Town with a team of 10 people. I mean, there's 8,000 stocks globally that you need to look at if you're investing and benchmarked against the All Country World Index, for example. So it's a tough one, but being globally integrated has its advantages.
Yeah, and certainly you've mentioned 8,000 stocks globally in the equity universe. When you get to bonds, there are many bonds, specifically when you look at corporate bonds.
100%.
This is where you need resources to analyze those.
Yeah. So I mean, in the global bond space, yeah, you can times that number by 10.
And we've certainly had examples before of where we would go lower in South African bonds and buy Brazilian bonds or Mexican bonds,
Absolutely.
where we see it's a fair trade-off to do, and we see valuation upside for the clients.
Absolutely. So, you're able to respond to global opportunities if you are a truly global manager.
There's a question here from Theo van Wyk from Alex Forbes about, does the change in regulation now shift the way in how we look at dual listed shares? I guess given the relaxing limits for foreign, you are now less forced to into dual listed shares and have a wider opportunity set to consider at least.
Yeah, I mean, that's a very interesting question. I think, off the top of my head, there's greater competition within portfolios for hard currency earners with obviously a wider universe. So you're going to have to evaluate even more keenly the opportunity set, dual listed versus similar companies in global markets. There's no doubt about it. But I think the evaluation of the companies doesn't change. It's simply in which pot do you want to allocate your resources. So, if you've got a massive allocation to hard currency brand hedges, for example, do you still think you want to have a high weighting in those similar stocks who derive similar revenue from similar markets with the other hard currency earners that you have? So it will, change somewhat how you look at them, but we certainly don't think it in a way, necessitates you chucking out all of your SA dual listed companies, because the fact of the matter is, we do have great companies that are run by very good management, well respected, and have, time and time again proven that they can grow earnings in a real sense and access markets in a responsible way.
Sandile, there's a lot of questions coming through, which I would say veer probably on the tactical asset allocation side of things. Noma Koza from Equilibrium Investments, great name, by the way. Noma, is about how does markets look on the shorter term, and Johan Libbe from our mutual also asking both about global markets having had a very, very poor start to 2022, and we saw it actually, both equities and global bonds have had a horrible start to the year.
Yeah.
Where do we currently find value? And I think you probably have to start that answer with, how were we positioned going into the year?
Sure. So as the audience knows, valuation is one of the things we spend a lot of time on. And, the recent episode goes towards illustrating somewhat the importance of that. So, the current investment zeitgeist in South Africa is, if global markets are having a hard time, by a definition then, or by extension, South African assets will have a hard time. But that's not what we saw in 2021, right? South African government bonds were almost bulletproof, even in the face of global real interest rate rises. SA equities delivered phenomenal returns in rands and even in dollars. So, the valuation of those asset classes is very important. The recent experience once again highlights that buying expensive assets is a risky thing to do. So for the first time in 30, 40 years, you had global equities and bonds selling off at the same time. I mean, if you are holding 30-year German bonds, I keep saying this, but it's a phenomenal stat. You're holding German government bonds in November, you're now sitting on 30% less capital. You've lost your money
in a supposed safe investment,
in the safest investment available, right? So this is where you have to be careful about just willy-nilly and willfully diversifying for the sake of it because you want to run away from South Africa. We don't think that's the right way to manage money, and we think your portfolio should be answering investment questions and not other questions. So yeah, I think we certainly are finding SA assets being very cheap. We like South African nominal bonds. We think they're priced to deliver some phenomenal returns. We quite like SA equities, as I've indicated, both on an absolute level and compared to global equities. The valuation is quite cheap, absolute and relative to those markets. And we have at the moment, given the prevailing valuations, a bias towards being overweight South African assets versus global assets.
Sandile, in that same light, there are questions about 1 year from Sean Dubuisson on a global 60-40 portfolio. So effectively, that's a global balance fund with an allocation of 60% to equities, 40% to bonds. Already a couple of years ago, we started to see that returns for such portfolios will be challenged, and we've obviously seen it this year. So the question relates, how do we see the future ahead for South African multi-asset portfolios, and maybe specifically after this change in or relaxation in offshore?
Yeah, look, in SA, we're spoiled for choice. So we don't have to be tethered to that 60-40 portfolio. If we plug those numbers into our domestic markets, you're still sitting with a very compelling return. I think the recent experience of the sell-off of the last 8 months just highlights how incredibly important your starting valuation is in where your future returns are going to come. So, you have to be, user beware as far as global assets are concerned. South Africa is slightly different. And, this is including all of the noise that we have to live with. They're still very cheap.
Sandile, maybe a last question is, all of us in South Africa have probably got a bit of a South African bias here. How do you communicate and have discussions with our global colleagues, whether they sit in London or the US, where they can have a more of a neutral view on South Africa and how they view that? And is that a useful thing to sense check our own views?
Sure. I mean, often, our London colleagues say they probably don't want to hear from us about SA assets, given how bearish we generally are. So it's definitely
even
useful.
Load shedding and riots exactly. And flooding.
Yeah, it's just, it's tough to live here. Yeah. So there definitely is that. And the discipline of focusing on valuations, evaluating the opportunities as they come, I think helps, and the input from people comparing us, not just as a single market, but comparing us to countries like Vietnam, Indonesia, Turkey even, and Mexico, really helps. And I think that's, once again, leveraging this global presence to try and in a way contextualize our opportunity set is very important.
Thanks so much, Sandile. And I think that absolutely talks about, the theme of this investment, this webinar, we've focused on how do we determine SAA, which provides us that roadmap. But as you earlier said, tactical asset allocation goes hand in hand with that, and the world is never always in an equilibrium spot. It's very important to use tactical asset allocation to value add around that. So thank you everyone for listening to us and staying online. I'm sure you'll get an email afterwards to give you access to the presentation if that's of use to you. If you have any more questions, please feel free to contact your sales consultant or your relationship consultant. Sandile, thanks so much for your time and sharing this. And good luck to all of you of navigating these new investment waters with much more flexibility. Thank you for listening.